All right, welcome to everybody for our December update webinar. We have a whole lot of things to talk about today. Um, Most importantly, we want to be, careful of everybody's time. So as we've always done, we're going to do the main prepared points for the first 30 minutes. And then if you have to log off and go back to work or just get back into your day, that's great. Then we'll reserve time for Q&A. So if you see your little doc, depending on if you're on your phone or on your computer, for Q&A, add the questions there. Courtney's already queued up some of those that you guys asked during the sign up process. So with that, we are going to get going. I always like to remind people, especially this time of year, that my favorite quote about the market is from Seth Klarman. The stock market is a story of cycles and of the human behavior that is responsible for overreactions in both directions. I found myself lately saying a few things. I don't take original credit for this. I've heard this throughout my 30 plus year career. But one thing I often say is history doesn't repeat, but human nature does. And that becomes really important. The reason what SEM does works is because the reasons behind the move in the market might be one way, but most definitely we see human nature go back and forth through those cycles that we have on that chart there. What we always remind people of is everybody experiences these cycles differently. Some have a really wide range, some have a tighter range. But that's what makes us human. That's what makes us beautiful and unique. But that is what allows SEM to do what we do in terms of quantitative risk management. The other thing that I'd say, especially now where we're at in this cycle, is history doesn't repeat, but it most certainly rhymes. So many people are looking for exact things like signs that this looks just like 2008 or this looks just like 2000 or 94 or whatever. And there are some things that look like those periods, but there's also some things that are different. So it's really important to understand that what drives those cycles is human nature, not necessarily the events behind that. So what we're going to talk about, five things. There is our agenda for today. The first thing we're going to talk about a recession watch. And what I do every year when we do these webinars is I want to remind people, especially now because it appears GDP officially is probably going to hit 3.5 to 3.8% when the next release comes out. But the main thing to understand is when that comes out, that's basically the government saying, this is what the economy did the last 3 months. We're going to essentially multiply that times four to get to an annualized number. Nobody else does that in any annualized statistics. The way you should do it is how are we doing versus a year ago? And that's what that blue line is on the chart, is to highlight the year over year change. So right now the economy is growing just over 2% versus a year ago. It looks like when the numbers come out, when the government finally releases that for the third quarter, it's going to be again right around 2% year over year, even though the official number might be 3.5, close to 4%. One thing that's important to understand, our long-term average is 3% annualized growth rate. 3.1 is the actual number. I've highlighted there since 2003, we've only hit 3% and had an economy better than 3% just a handful of times. So we're growing at a 2% rate, but the average is 3%. When we want to compare things, I hear so many people say, well, this is like the 1990s. If you go back and look at the 90s, we consistently ran above 3%. We had times where we were over 5% growth. And if you look at where we're running now, you could see today's GDP is at the same level, the worst of the 1990s. So this is a completely different economy than what we had in the 1990s. The 1990s in our lifetimes was definitely the heydays. I'm hoping we can get back to growth like that, but we are nowhere close to that type of an environment. And that's just a fact of life that we have to deal with. And we're going to talk about some of the things, the reasons we're not at that 5% level as we go throughout today. But More importantly, our leading economic indicators, obviously, we've had a little bit of a blip because of the government shutdown. They've just announced they're going to essentially skip some of the October data, go from September, and then we're going to jump into November data. We did have mechanisms in place to plan for this because, as you'll remember, we did have a government shutdown during Trump's first term. We had another one during Obama's term. We had some back with Gingrich. So we were prepared for that. But in general, most of the leading indicators are leaning negative. But what I think is interesting is if you go back to pre-COVID and say, well, what has driven the economy since COVID? What's doing better? And it's really eye-opening. The money supply. We've flooded the economy with money, both from the Federal Reserve and from Congress. Stock prices have done really well. Consumer spending is up. And then durable goods orders, this tied a lot to the stimulus checks were really high. But if you think about now we're 6 years removed from 2019, jobs are only up 5% over that 6 year period. Hours worked are only up 5% over that 6 year period. And then you look at things that are actually below 2019. And this is starting to become important because we have a fractured economy. Is capacity utilization of factories is barely at 2019 levels. Building permits, housing activity is lower, service businesses are lower, and consumer sentiment, which we'll talk about in a second, is much lower. Looking at our heat map, this is something we put in the blog. I haven't updated it because we do have a lot of gaps with October data, but you could kind of see jobs as one of the areas of concern. Just this morning, ADP put out the current estimate of private payrolls. This is a little bit different than the official payrolls numbers that we'll see. This is, non-government jobs. And you could see the definite downtrend since fall of 2024, so a year ago. That is a problem for our economy. And that is something that the Federal Reserve is obviously looking at. But we are seeing the number of jobs, created grind almost to a halt. More importantly, though, is consumers have not felt worse other than the lows of 2022 in all of our lifetimes. We've never seen consumers so pessimistic overall, and that's starting to become a problem. And one thing that people forget is we started calling the economy the K-shaped economy. Of COVID literally broke our economy. The solutions to COVID broke it even more. And we talked about this throughout the pandemic. We talked about it again in 2022 when we had inflation. But essentially, if you go back to the pandemic, if you were able to do your job on a laptop, and I add an asterisk, or if you were retired and still receiving your pension and Social Security check, you actually had more money because the economy was locked up and you could not go out in public and spend money on things that you used to spend money on, like eating out, going to movies, things like that. But if you physically had to go to work, your income was hit severely, and the stimulus checks did not do enough to help. And so I added this chart, and for whatever reason, March of 2024 was when sentiment peaked. I can't find an actual event, but from the March of 2024 on, consumers have felt more and more pessimistic. But stock prices have just kept going up. Consumer spending has just kept going up. And one thing that I think is fascinating is the top 2% of our economy generates 60% of consumer spending. So they're doing fine. They're spending money on big ticket items. That's keeping consumer spending overall up. But the bottom 90% are now reporting deficits in some of their monthly budgets, where they're now, because of inflation being such a problem, they're spending more than they're taking in. And we're starting to see that show up in credit card delinquencies, other defaults. It's just slowing down. Earnings reports from companies like Target are reporting that consumers are definitely pulling back their spending on the middle class and lower side. So just because stocks are continuing to go up in the face of this doesn't mean we can keep going. And the thing we talked about with the K-shaped economy, and again in 2022 we saw a little bit of a preview of that, is if the bottom part of the K continues to decline, the support for the upper half kind of crumbles and things start to come back down. And that's one thing we're looking at as we go into 2026. Now, let's take a step back. I've spent several years this time of year talking about potential GDP, which boils down to mathematically, your economy will grow at the formula of how many people are working, how much are they producing. The problem is we haven't reached potential for about 40 years. And that's because we got to add some brackets here to subtract out interest expense. Because if you borrow money, you have to pay that back plus interest. So if deficit spending is supporting your economy, that will pull you down from potential. And then the net exports, which is our trade deficit. So we're going to talk about each of those things because that is very important for our economic outlook. First off, interest expense, government spending. I pulled a chart here. The first one is current expenditures, and I drew this bottom line here was the trend pre-COVID. And now this trend is the trend we're following post-COVID. So here you have all the stimulus spending, but we did not reset back down to the trend in terms of government spending. We have continued at a higher rate. If you look at government spending as a percentage of GDP, you could see that the only times we've been this high has been following a recession. We are now 6 years removed from the recession of 2020, and yet we're still spending money like we're in a recession. And that's a problem because that adds up to net interest expense, which pulls down spending. I always say that debt is future spending brought to the present. It's brought forward. Now, when you break everything down, and this is not a political statement, it is just the facts. This is a chart of the categories that we are spending money on. And I rolled up retirees. That includes Social Security, Medicare, and federal government pensions. You can see back in 1966, that was 25% of our spending. Now today, it's 53% of our spending right now. So 53% of all government spending is going out to retirees, not younger people who are currently working. And then you can see where everything else comes. The second biggest category now is net interest. So we're spending now close to 18% of all government spending is going to interest expense. And then you could see some other things that's now surpassed defense. And you heard a lot of fighting over Medicaid lately when we had the government shutdown. That's actually lower than defense spending. And then all the way down here is education spending, which seems like they're spending a lot of time focusing on and not much else on all these other things. And here's the other thing I point out. We talk about wasteful spending. Everything not included in these categories is about 5% of our spending levels. So the analogy I've always used is imagine a couple, they're trying to figure out how to pay their $2,500 a month mortgage. They spend the next 9 months fighting over whether they should cut Netflix or not. They're not looking at the big picture. We are going to have a broken economy until we figure out how do we not spend half of our budget on retirees. How do we go back to the true way you grow your economy? Put people to work and help them produce more. Because unfortunately, retirees are not working and they are not producing anything. So that is a drag on our economy. And America, unlike the rest of the world, is in a position where our demographics are such that we do have large generations and millennials and Zoomers coming in behind that are much bigger than the baby boom generation. But right now, because of the K-shaped economy, there's not a lot of opportunities for those younger people to make money and have the success of the baby boomers. So that's a long-term problem. This update is focused on next year and how to position things. But keep this in the back of your mind every time there's a budget fight. Because remember, we're going to have another budget showdown in January of 2026. And they might spend all their time fighting about these categories and still do nothing about this. If we keep ignoring this, by 2032, 2033, Social Security and Medicare are going to be insolvent. And then we have really hard decisions to make about Do we cut benefits to retirees? Do we have to do other things? So the time to act is now, not in 2032 or 2033, but that's getting very, very close. That's in less than 10 years for us to try to figure out how to solve it. The other thing, I just threw this in there to point out something. You could see the average age of the Senate is now 64 years old. It continues to go up. The House is finally flatlining a little bit. We're starting to see younger people come in. And this isn't an ageist type thing, but America's always been about the next best ideas. And we need to get to the point where we're letting younger people use their ideas to try to generate things, because what we have right now is not working, and it's pushing us towards the edge of very, very low growth. And that's something that we need to, keep focused on. So, recession watch, our economic model is definitely leaning bearish. It's not saying recession just yet. And that was one of the questions we'll address at the end, but it's definitely saying that we're running well below average, and all the indicators are showing that the momentum is down, not up. And that's something that we're going to watch for. So the other part of potential GDP that's being subtracted out is our trade deficits. That's net exports. And you can see this bottom line is our trade deficit. And going back to 2018, remember, we implemented tariffs during Trump's first term, and we did not take those tariffs off. We took a few off that expired, but for the most part, we kept tariffs, yet our trade deficit went up. So the question is, are tariffs going to reverse our trade deficit? The answer so far is no. This is a chart that shows our average tariff rate and our trade deficit. And you could see that actually, as tariffs went up, our trade deficit also went up. And I can't really explain that other than people are trying to front load their purchases. So it actually overinflates. So if they know a tariff's being implemented in 30 days, they try to rush and buy things. And so that misconstrues things. As things level out, it theoretically should change. But so far, our experience over the last 10, 15 years has been, if we increase tariffs, our trade deficit actually goes up, not down. So time will tell. It is so early. I will say this. First of all, remember, I'm a registered independent. I tend to offend people on both sides because I don't agree with everything they say. I think both sides have some solid arguments, and I can't pick which one I would lean towards, which is why I'm an independent and not affiliated to either party. But I will say this. At least this president is doing something about a very long-term problem that we have to address. We cannot continue to rely on other countries for everything we do. We can't export everything to other countries. We can't have our supply chain based in other countries. We need to produce things here. So at least this president has the guts to do that. Nobody else, starting with Kennedy, had the guts to do what Donald Trump is doing. Right or wrong, like him or don't like him, somebody has to do this. And somebody after President Trump needs to continue to figure out, how do we make things here? Because remember, our economy is about how many people are working and what are they producing. And we have to manage our budget deficit and our trade deficit. Now, unfortunately, this president, like the other president, like all the presidents since George W. Bush, has spent more than we've taken in. And that's a problem, because we have to address the other side of that. So that's something we have to look at. The other war that we talk about, Fed policy and inflation. This is something I think short term we're seeing the market key off of, hey, if the Fed's going to cut interest rates, that's a positive for stocks. But that's not been the case. The Fed has a very poor track record of preventing recessions. And I point out that the last several recessions, they were already cutting rates when the recession started. You could see they started cutting rates and we still had a bad recession. Every time, even during COVID, same thing. The other thing to point out, inflation is going the wrong direction. I am not obviously somebody that the Fed would listen to, but here's the problem. If inflation starts getting out of control, as we learned in 2022, it's very hard to stop. So we're seeing policies from this administration discussed. The dividend checks going out to people of $2,000. We know what happened last time we sent checks to people. inflation skyrocketed. We know that if the Fed cuts interest rates, inflation likely goes up. So we're doing things that are not going in the right direction for inflation. So maybe the Fed cuts rates, but that might not have the same impact that people think because sentiment is so bad. Just sending people temporary $2,000 checks is not going to solve things if inflation keeps going. So that's something to pay attention to. Now, moving on. Number four is AI and productivity. And this is something we've had to talk about for the last year. It's now, I believe, the 3-year anniversary of ChatGPT coming out. There's been a lot of good things happening. We've been talking about it quite a bit. Here's the problem I'm having is I obviously lived through the 1990s, and I don't like when people call it the dot-com bubble because what we really saw was just a technology bubble because we went from almost unattainable microcomputers in the early 1990s. I remember working an accounting job where we were so excited to buy one computer that cost us $3,500. By the mid 90s, you could buy a computer for about $1,400. Still expensive by today's standards, but finally people could afford to have a computer in their home. You could have multiple computers on a small business's in a small business office, and you started to see that. The internet started to come around with dial-up. That was not good enough to do things, so we had to have a broadband build out. So it wasn't just dot-com stocks that were participating. We were literally having this productivity change. And I put this productivity chart up here for a reason because you can see right at the point of the stock market really inflating, productivity bottomed and just went up almost straight up for 10 years. So everybody was right that the technology broadband build out made everybody much more productive. The problem is the spending that was needed to get there got us in a bubble only to have us, have to have a reset. A lot of the companies that are driving the internet today were not even around in 1995. Some of them, yes, survived, but a lot of them weren't. So I fully believe AI is going to make everybody more productive. My issue comes to, are we at the point where this is going to start cash flowing without having a bunch of failures that causes a reset in the stock prices? Now, one thing that's fascinating is hyperscalers. There's some of them mentioned Amazon, Meta, Alphabet, Microsoft, Oracle's included in there. The number I saw from whether it was Goldman Sachs or Morgan Stanley, they believe that 0.5 to 1.5% of GDP growth this year, and remember, we're running at just over 2%, is all driven by capital expenditures from these hyperscalers. In other words, the AI build out is literally keeping our economy afloat. Now, one of the problems I have with this, though, is this circular connection. And these deals are just getting to be mind-blowing of NVIDIA strikes a deal for somebody to either buy or lease their chips, but in exchange, instead of getting cash, they're getting shares of stock. Like it's this whole circular thing. And Morgan Stanley tried to put together this chart, and this is a couple months old. There's a lot more deals that NVIDIA keeps making, and now Google is doing some with Meta, and it's just getting very convoluted where nobody's making cash. They're all just kind of supporting the whole infrastructure. And maybe this works out great, but at some point it has to cash flow. And, the thing that's becoming more and more of a concern for me is the tech companies are offloading these data centers into special purpose vehicles to get them off of their balance sheets, except for that they're also having equity in these, so they're valuing them at a certain point. Well, it's not publicly traded, so the valuation is kind of what the accountants say the valuation is, with no free market to declare it. And then we're seeing this spun off, a little bit similar to 2005 into these collateralized debt obligations where, hey, the first 3 years of lease payments are AAA, and then the next 3 years are AA, and then after that they're single A, and they're being sold to private credit companies, to insurance companies, and pension plans and investors, um, with this belief that there's just going to be this nice built-in stream coming in, and I think, based on my experience, because in the 90s we had vendor financing, and then in the 05, 06 period, we had all this structured finance. We're kind of seeing a mismatch. Remember, history doesn't repeat, but it rhymes. And we kind of have some rhymes of both prior bubbles. If the financing falls apart, that's going to be a problem. And so that's kind of when I look at my outlook for 2026, it comes down to the question of, will this financing scheme fall apart? Or will we start seeing real, actual cash earnings at the result of these investments? And it's too early to tell that. It could literally go either way. So, how do we set expectations going ahead? Wall Street is overwhelmingly bullish. We're seeing 13% earnings growth this year. They're expecting even better growth next year. To put that in perspective, this blue line is the long-term average of about 10% earnings growth. This pink line is a 16% earnings growth. We're in pretty rare territory. Doesn't mean it can't happen. Look at 93, 94, 95. We had 28, 18, 18. You look at 2018, we had 18% earnings growth. We could see 16% earnings growth, but if that doesn't happen, we're going to see a major correction in stock prices. And unfortunately, I don't like doing an outlook like this, but we could either be where we have another year, 2, 3 years of this build out of the AI infrastructure, or we could already be seeing it roll over. In other words, this could be similar to a mismatch of 2005 and 1995, where we could be looking at 2, 3, 4 years of spectacular growth. We could be that early. Or if that vendor financing and these private credit vehicles fall apart, and we have seen some failures, not on data centers, but on other private credit vehicles, which could start to spiral into the rest of the space, we could have already rolled over. I don't know. What's more important from expectation setting is to ask yourself, is this the new normal where the Federal Reserve and Congress will always be there to support stock prices? Or remembering everybody was right about how much technology changed our economy, but over the long run, the stock market's only averaged 9%. And that number holds up if you go back to 1980, 1950, all the way back 100 years worth of data now to 1926. You get an average return of 9%. Has AI changed things enough to say we're going to always have 14, 15% growth when never in the history of our country have we had that? Or are we going to revert back to the mean? I don't know. Again, it comes down to data center financing and the vehicles supporting that. When you look at cycles, what we're most concerned about is a recessionary bear market tends to take 42% off of stocks, and it lasts almost 2 years. If there is no recession, the market could go through a quick drop and then recover very shortly in less than a year. That's what it all comes down to when we look at it. And again, the key is going to be the ability for the economy to weather this little downdraft that we're having right now. And if we're going to be able to keep seeing money pouring into these data centers from private credit to keep the support going. We update this every time on our blog. We're bullish in all of our models except our dynamics, which are our economic models. So that's kind of where we're at. Few resources if you do have to log off and go back to work. SEMwealth.com. If you're questioning your allocation or you just want a quick portfolio review, SEMwealth.com, click on more, go to risk questionnaire. If you're interested in following along to our blog, scroll down below Market Insights and click on that. That takes you to the blog that I write every Monday. just from for your kids or grandkids or even for your own self. We have some financial literacy, social media stuff, and then we're going on to season 2 of the podcast, the Money Talks with Dad that I'm doing. Now we actually have 2 of my kids involved in this podcast. So with that, I'm only 1 minute over the prepared remarks.